Okay, we're going to go ahead and get started. I think we have quite a few participants already online. Once again, this is Oghoorian. I'm with ACap Advisors and Accountants, and I'm here with Tom Fiebig with, let's see, we'll go to the next slide here.
Mission Valley Bank.
Mission Valley Bank. And Tom, why don't you give a quick background about yourself, and then when you're done, I'll give a background about myself as well.
I've been in banking over 25 years in commercial lending and from management standpoint, and been through a lot of credit classes, done a lot of experience under my belt regarding all the stuff we're going to talk about today. So I'm very excited to be here. I think it's going to be a great presentation, and I'm really looking forward to this. So thank you, Ara.
Thank you, Tom. Thank you very much for being part of this. And with a little bit of background about myself, I'm Ara. I'm the founder of ACap Advisors and Accountants. We are both a wealth management firm and a full-service tax firm. And we have a specialty in working primarily with healthcare professionals. So a large part of our clientele are physicians, medical groups, anyone really under the umbrella of healthcare. And I've been in finance and accounting for my entire career, well over 25 years. And I'm excited to do this with Tom as well. And also, I sit on the board of directors for Mission Valley Bank as well. So in full disclosure, Tom and I work closely together in other capacities. So moving along, I want to talk a little bit about what we're going to learn in this presentation. We're going to talk about the different types of financing that are available to businesses. And Tom's going to go deep into that. We're going to talk about repayment structures and how they can be structured to meet the needs of your business. Then Tom's going to pass it on to me, and I'm going to talk about when is a good time to start borrowing. We're going to do a case study on a particular a business, a fictitious business. We're going to look at some of the key financial statements that not only banks and lenders look at, but that as a business owner you should be looking at. We're going to look at the balance sheet and the income statement, and we're going to look at some numbers between those. And we're also going to look at some pertinent ratios that are derived from those financial statements to help you get a better gauge of how your business is doing, but also those ratios that banks use to determine whether how much to lend to a business and whether a business is a viable entity. And then lastly, we're going to close it out by discussing how your trusted bank, such as Mission Valley Bank, and your advisor can help you with that process and your growth. Okay, so without further ado, Tom, I pass it back on to you.
Super, Ari. Thank you very much. So we're going to talk today about short-term financing and long-term financing. Let's start off with short-term financing. Generally set with rules for it's generally set with terms for lesser than 1 year, short term. What does that mean? That means that within 365 days, you use the credit facility and you go in it, you use it, and then you come out of it. You don't stay in it long term like on a mortgage, for example. Some of the common forms of short-term vehicles you can use are credit cards, for example. People use credit cards on a short-term basis on a personal side when they can go in and they buy something, but then at the end of the month, they pay it off in full. Another form of short-term lending is lines of credit. And in the commercial lending arena, we love using lines of credit for businesses that have seasonality, or they have primarily seasonality. And that can be everything from agriculture to manufacturing to industrial. It goes across the board. But a line of credit, again, is interest only. It is not principal. So what you do on a line of credit when you advance off it, or just like on a credit card, you advance off it, if you keep it outstanding, you're going to pay interest on it at the end of the month. If you pay it off at the end of the month, on the line of credit, you're still going to have interest owed, but on a credit card, you're not going to. Another form of short-term financing is letters of credit. And there's two different types of letters of credit, standby and commercial. Standby is geared more for performance, meaning if a company exercises a service within a year and they perform that service, then the letter of credit is not called on. On a commercial letter of credit, it's more product driven. So if you are an importer or even an exporter and you're bringing goods in from overseas, you may use a letter of credit to get those goods here. That's when you don't really, you don't trust the people overseas, or if you don't have a good borrowing relationship with them. You want to make sure that you get the goods before the money is paid. Otherwise, people who don't use letters of credit, they typically know the vendor overseas, they'll pay them, then they ship the goods over. Letter of credit will allow you some flexibility and some financing. There's terms involved with the letters of credit that once you get it, you have 30 days, 60 days, whatever the terms agreed upon, to repay that. So that's a nice form of lending as well. And we see a lot of importers use the letters of credit on bringing product into the United States. We also have bridge loans. And what's a bridge loan? Do we make loans to build bridges? Well, you could, but on a bridge loan, it's just a temporary financing instrument. Meaning, if you're out there to construct a building or a facility or something to that extent, you get a bridge loan, a short-term interest-only loan that lasts for typically about a year. Sometimes they'll go a year and a half, but they're typically a year or less, and they're interest-only, and it allows you to advance funds off the instrument to pay for all the expenses. The bridge part about it is at the end of that year to maybe year and a half, then you go into a permanent loan. So you roll into a permanent loan. So you're going to have two types of loans there. The next type of short-term financing is SBA financing. The SBA has two programs. One of them is the S7A and the 504. The 7A is a line of credit, and again, it should be used just like a regular line of credit, but it's SBA guaranteed. It's backed by the Small Business Association, and they help a bank. They guarantee a bank that a certain percentage of the line of credit is guaranteed. If the bank performs accordingly, then the SBA, if something goes wrong with the borrower, then the SBA will step in and pay the borrower back a certain percentage. We also have accounts receivable financing. A lot of businesses have accounts receivable, and we can get into the management of your receivables, but I come across businesses all the time that are not properly managing their receivables. They make terms of 30 days, but yet their receivables are out there 45 and 90. And they'd be surprised on how much money they can have into their cash flow position if they would just monitor those accounts receivable financing. Again, we use that from a borrowing base certificate. So we monitor the receivables on a monthly basis. And that's another way we help businesses manage their receivables as well, is through the borrowing base certificate. So I've gone over some different types of just short-term financing. Let me just jump into some long-term financing. Long-term financing is geared really for 1 year or more. You can go 5 years, you can go 7 years, you can go 10 years, 15, 20. The common types of that are credit cards. Oh, wait a minute, credit cards? Tom, you just said credit cards are used short-term. That's correct. If you use a credit card properly, it will be just short-term. But some people, and if you look at the statistics out there, don't use credit cards on a short-term basis. They use them on a long-term. I think they call it for Christmas. It's before Christmas, it's ho, 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 and then after Christmas, it's oh, oh, oh. Well, most people will use credit cards. They'll get in debt, and then they take a year or more to pay that debt off. So that's how that can be construed as long-term. They don't have a final maturity on that instrument. Term loans. A term loan to a business is typically 4 to 5 years. Occasionally, you'll see them 2 to 3 years, depending on the cash flow of the business. But a term loan is money infused into the business for permanent working capital. Permanent working capital. That means that a business will use this money and build their business with that capital. They pay it back over 4 to 5 years, but it builds up their permanent working capital position. It helps their cash flow. And every business has a cash flow position, and we'll talk about that a little bit, but it has to do with your receivables, your payables, and your inventory. Those three elements come together to determine a business's cash flow position. That's very important, because if a business is short on cash and they don't have a line of credit to lean on, or if their working capital position is deficit, they're going to have problems. And if a business can't make payroll, business can't stay in business very long. The next type of long-term financing we have is equipment financing. Equipment can be everywhere from machinery to forklifts to tractors to 18-wheelers. And equipment financing typically goes about 4 to 5 years. We don't want to take it out too far. You don't really want to see 12 to 15-year equipment loans out there. even though some equipment has a life expectancy that goes far past that. You don't want to, you want to keep that kind of short term, 4 to 5 years, and that's what equipment financing is all about. We finance also machines for the professions as well, for like doctors and veterinarians. Yes, we do. You'll find some of the vendors, though, provide financing for that may be a little more competitive than what we can offer, but they do offer it. So again, equipment financing is a very good tool for long-term financing. The next type of long-term finance we have is commercial real estate. Very few people get out there and buy cash for commercial real estate. A smart way to manage your money is to pay for commercial real estate on a long-term basis. And therefore you go, 15, 20, 25, 30 years on a commercial real estate. Are there fixed rates and variable rates associated with that? There are. There are a variety of different programs when you go to purchase the commercial real estate. Most lenders want to see at least 20% down. The more down you have, the better it is, because it takes the risk factor away, which then can relate to a lower interest rate. But again, commercial real estate, a great way to buy a building, buy some investment property, but that's all long term. You don't see that paid back within a year. The next type of financing we have is SBA financing. Again, it's long-term financing. It's like their 504 product, which deals with commercial real estate. But again, it's got the SBA guarantee on that, and banks love that because that takes a lot of the risk off the table. And that's the whole part of financing, is you want to minimize that risk factor more than anything else. The higher the risk you have, the higher the interest rate you're going to have. So let's talk a little bit about, move on to the next screen. Oh, did we do that? I don't think we kept up with those screens there. Let me move up to that. There we go. Short-term repayment. Sorry about that, folks. Short-term repayment, common forms. Again, we talked about on the lines of credit, interest only with balance due at maturity. Will you see monthly principal pay down in interest? You can. Even on a short-term instrument like a line of credit, for example, you can advance it all in January. Say it's $100,000, and you can pay $10,000 principal every month through November, plus interest, and by the end of the year, you got it paid off in full. That's a good way to use a line of credit. Another way to use a line of credit is that you use it, say $100,000 in January, you get all your receivables in, you pay it back off in March. Predefined interest payments and flexibility to pay down the principal at borrower's discretion. Again, on a line of credit, for example, you can advance it and you can pay it back at your discretion. If the receivables come in sooner than you think, pay it down. If it takes longer, that you stretch it out further, then that's what can happen with that as well. Long-term repayment, common forms, predetermined amortization set to the term of the loan. Typically on a long term, you want to have it amortized, which is your monthly payments, structured to the maturity of the loan. Occasionally you'll see something like a 30-year amortization with a due in 15. So that means after 15 years, you would have a balloon payment due. You don't see that a lot, but in certain circumstances, that is very applicable. On a long-term basis, you definitely have scheduled payment terms. They're either monthly, quarterly, or annually. Very rarely do you see annually, but it depends on the business cash flow and what product they're actually out there selling. Loans may provide a shortened call provision. This allows for the maturity to be earlier than the amortization. As I mentioned, you could have a 30-year amortization with a 15-year call on it. Those are kind of rare because lenders really like to see it fully amortized, but those are out there given the circumstances. I've done a couple of those, but they're definitely fun. Next thing we want to talk about, short-term financing, fitting the financing to the purpose. I want to get to short-term uses here. There we go. Okay, short-term financing, short-term needs. What are those kind of needs? What would they be? Temporary working capital, seasonal sales. Agriculture is a great one for that one in that respect. Production and fluctuations. I've had money managers, for example, where they have a big expense in January, February, but they don't get their money in till March, April. That's a good product. Raw materials purchased to converted to finished product. Again, that's something you can do within 1 year. You can take those raw materials, convert them into a finished product, and sell them. So a line of credit would work perfect for that. Interim production financing and interim construction financing. I think we talked about bridge loans, and that interim construction financing is what we're talking about when you talk about bridge loans. Long-term uses. Commercial real estate, we talked about that. All the way, if you're going to purchase or you're going to refinance, you would want to use a long-term instrument, not a short-term. Capital infusions support long-term growth. Again, we talked about a working capital position that a business has. If it's deficit, if its working capital position doesn't have the numbers it needs, then they're going to have cash flow problems in the business, and it causes a lot of stress. But if you have the right working capital, then the business will operate effectively and efficiently and go forward. Again, long-term equipment purchase to support growth and expansion. Equipment that's going to, like a printing press, for example, that's going to bring you long-term profits and income. Boom, there you go. But it's got a long-term use to it. And then again, if you're going to purchase a business, very rarely do people get out there to buy a new business, like a veterinary, for example, where they will buy a business and then pay for it in short term. They typically stretch it out to a long-term payment that meets the cash flow position of the business. And that's what we like to do, is we really like to take a look at those opportunities to make sure that for example, a veterinarian, when he buys a business, he or she buys a business, you want to make sure that the business is generating enough cash flow to service the debt. Many times we've seen businesses out there with a selling price way above what the cash flow can service. That becomes a problem. At that point, Ari, I'd like to have you talk to us a little bit about when to borrow.
Okay. Thank you, Tom. That was some excellent information. And I love that comment about ho, ho, ho in December and then o in January. I've never heard that before. Incredible. Before I go on, I want to mention that this webinar is being recorded. So if you did not get a chance to look at it later on, this will be on our website. It will be on our different social media platforms. You'll have an opportunity to view at it later on, especially because Tom had some really excellent comments on different types of financings and when to use different types of financing. So a lot of really good information. So this is definitely going to be recorded. Secondly, if you have questions, please put them in the question box, in the Q&A box on your screen. We are going to get to all the questions at the end. We just want to be able to have time to go through all the presentation slides, but I promise you we will answer all the questions at the end. So with that, as I mentioned, Tom talked about all the different ways of borrowing and all the different types of borrowing methods there are, whether short-term or long-term. What I want to focus on is, now that you've borrowed the money, how is it presented on your balance sheet? And when is a good time to borrow? When do you identify a good time to borrow? So with that being said, when is a good time to borrow is a good indicator is when it creates liquidity for you. Because when you borrow money, whether if it's through a line of credit, a term loan, equipment financing, that is cash that comes into your business and is being able to be used to grow your business for a variety of purposes. And that cash that's coming in could be used to arbitrage that growth. And what I mean by that is, if you're able to borrow at, for example, 8% or 9%, and you're able to use those funds, whether if it's to purchase equipment or to hire someone or to take on additional office space and to grow at greater than 8%, at greater than that borrowing cost, then all of a sudden you've created what's called an arbitrage opportunity. You have allowed your business through leverage to grow at a faster rate. The other thing that it's important to do when you're deciding when to borrow is to calculate your payback period. Now, there are different ways of calculating payback periods, and I'm just going to use a very basic approach that does not take any discounting into consideration. So let's assume, for illustrative purposes, that you borrow some money and you use it for equipment financing to get $1 million equipment. And with this equipment, you're able to do, for example, procedures that cost $1,000. And by doing this, you're keeping those procedures in-house, so you're not outsourcing them to another place. So you're keeping the revenue within your firm. And if you do if each procedure costs you $1,000, that means that your break point is 1,000 procedures. So after you've done 1,000 procedures, then you know that you've made enough money from that equipment to pay it off. Now, this is a very simplistic example, but you should be going through these exercises to see how long it's going to take you to recoup the cost that's associated with buying that equipment or buying that building or whatever it might be to generate revenue for you, to see how long it's going to take you to recoup that cost. And as I mentioned, there are many ways of calculating payback periods, but that's just a very basic way of doing it. The other thing that's really important to note is that interest rate is deductible. So there's a stated interest rate, which is what your bank gives to you on your loan commitment term sheet, but there's also the effective interest rate, and I'll describe what the difference is between the two. So the stated interest rate is essentially what you're obligated to pay, and the effective rate is your stated interest rate multiplied by 1 minus your tax rate. So for example, let's say your loan rate is 8%, and you're in the 35% tax bracket. Well, because that interest is deductible, your effective rate is actually 5.2%. 8% times 0.65, your 1 minus your tax rate, means that you're effectively paying 5.2% on that debt. So if you're able to grow your business by more than 5.2%, you've automatically created arbitrage for your business because you've borrowed at a lower rate, grown your top line revenue at a higher rate, and you've created excess capacity for yourself in that respect. Again, if you have questions related to this, please go ahead and ask them in the chat box, and we'll get to every single one. Let's go to a case study. And this is a fictitious business. Let's go and assume that we have Vandelay Pets Incorporated, an S corporation, and it's started by Dr. Vandelay, who is a veterinarian. They have $1 million equipment loan that they're going to use to buy equipment, and they have an unsecured line of credit for $100,000. In addition, they also have some other assets and some liabilities. They have some cash on their balance sheet, some accounts receivable, credit cards, and some accounts payable, which we'll go through each one of them separately. Let's look at the balance sheet first. If we look at the balance sheet, we'll notice on the left-hand side of the balance sheet, you'll see, and we always start off with the most liquid asset first, and then we go all the way down to the least liquid asset. And I'll describe what I mean by liquidity in a minute. The most liquid asset is cash in a bank. So in this case, Vandelay Pets Inc. has $75,000 of cash in a bank. And liquidity is defined as anything that can be easily converted to cash. So obviously cash is cash. So that's why it's the number one thing on the balance sheet on the asset side. The next most liquid item is accounts receivable. Accounts receivable is when you sell something to a customer or a client or a patient and you have not been paid yet. And there are different terms for accounts receivable. You could have 30 days, 60 days, 90 days. Hopefully you don't want to go anything more than 30 days because that means the staler that accounts receivable gets, the less likely you're going to get paid on it. So you want to have accounts receivable that's going to convert into cash relatively quickly. So in this case, Vandelay Pets Inc. has about $30,000 of accounts receivable on their books that hopefully will get cleared up in a short period of time. The next item on the balance sheet is fixed assets, and this could be either a building, it could be equipment, it could be leasehold improvements, it could be a variety of items. In this case, it's partially equipment for this particular business. I create a very simplified balance sheet just for illustrative purposes, but a number of other items could show up on a balance sheet's asset side or the liability side. And then we see the total assets of about $3.6 million. When we're looking at a balance sheet, there is one particular ratio that is important for not only businesses to know, but also bankers look at as well, and that's called a current ratio. A current ratio is essentially your current assets. Current assets are anything that is convertible to cash within a 1-year period. In this case, the current assets of this business is going to be $105,000, which is the cash in a bank and accounts receivable, because cash, again, is very liquid, and accounts receivable is going to be converted to cash within a very short period of time, within a year. Anything beyond a year is non-current asset. Okay, and it's important because we're going to get to a ratio that's going to be using current asset. If we move over to the right of the balance sheet, we'll see that we have the liabilities, basically the debts that the business owes to other people. Same principle applies. Current liabilities are things that are due within a 1-year period, and then long-term liabilities are items that are due over a 1-year period. So in this case, this business has about $12,000 of credit card debt. Again, it's due within a 1-year period, so it would be classified as a current liability. They also have some accounts payable, about $20,000, also due within a year, so it would be a current liability. And an accounts receivable is basically the opposite of an accounts payable is the opposite of an accounts receivable. Accounts payable is when you buy something on vendor credit. So if you're buying equipment, if you're buying office supplies or things that you buy on vendor credit that you have to pay within 30 days or 60 days, this is where it would fall. And the objective is that you try to clear these out within a relatively short period of time. The sum of the two items, credit cards and accounts payable, would be your current liabilities. So we talked about what a current asset is. This is what a current liability would be. And any portion of long-term debt that's due within a year is also considered a current liability. So keep that in mind. So for example, if you had the $1 million debt and $10,000 of it was due in a 1-year period, that would be brought up to a current liability and captured within that current liability ratio. We see that we have long-term debt on the liability side, and then the equity is essentially the difference between the assets minus the liabilities. Okay. So again, I know it's a lot of information to absorb. If you have questions, please feel free to ask them in the chat box and we'll get to it at the end. The other pertinent statement that's important to look at is the income statement. And the income statement, I should have mentioned, the balance sheet is a snapshot picture in time. So typically when a balance sheet's prepared, it's for a given day or a given month end. The income statement is for a time period. So typically it's a 12-month time period. And in this case, let's say we're talking about the year 2018. So a full year of 2018. And the way that a income statement works is the net income on the bottom, which I'll talk about in a minute, flows through to the balance sheet. So any money that's left over basically becomes equity on the balance sheet of the company. In this case, Vandalay Pets Inc. has $1 million of revenues or total income that they received. They have what's called a cost of goods sold, the expenses that are associated with generating that income, about $400,000. SG&A is essentially selling general and administrative expenses. So whether if it's office supplies, fuel, anything that is basically general and administrative expenses. And then the key items, which we'll dig deeper into later, is the interest on the debt. As you can see, it's deductible. And then depreciation on any fixed assets. Depreciation is a non-cash expense. What that means is even though it's deductible on the income statement, there's actually not a cash outlay that's associated with it. So the business gets a benefit from the depreciation deduction, but they don't have to actually write a check for that depreciation. So it benefits them in that it creates immediate cash flow for them in that respect. So let's see how these two statements work together. If we see them side by side, let's first look at the bank debt. We'll see that on the balance sheet, the bank debt, you have $1 million of bank debt, and then you have interest of $50,000 a year. Now let's assume that the loan payment's $8,000 a month. Well, not all of that is going to go towards paying interest. A portion of that is going to go towards paying down the loan, but only the interest part is deductible. Anything that's going towards paying down the principal is going to reduce the liability side on the balance sheet. Okay, the interest portion is going to be showing up on the income statement and is a deduction against your revenues and on your net profit. Earlier, I mentioned the effective rate of interest rate. This is essentially what I meant. When you have a deduction for interest, the stated interest is actually lower because you're getting a benefit from that interest payment that you're paying. The other benefit that you get from having bank debt, especially for equipment, is that the equipment is depreciable. So you can depreciate that equipment. It's a non-cash expense, so it goes against your income on the balance sheet. I'm sorry, in the income statement, and it's also reduced. It's called a contra asset on your balance sheet. So on the fixed asset, anytime you have depreciation, that depreciation amount slowly reduces the amount of the fixed asset that you have until you get to the book value of the asset on your balance sheet. Let's go to some ratios. So now that you have a good understanding of what the balance sheet is, what the income statement is, how the debt shows up on both of these statements, let's look at some key ratios, because these key ratios are not only important for you to know as a business owner, but they're also important for a bank to look at, because they want to see how viable the business is. Are you likely to pay back the debt? Is it how liquid is your financial position? So these are just some key ratios. They're not all the ratios that banks look at, but these are some pertinent ratios. One of them is the debt to equity. And the debt to equity is essentially the total debt a company has divided by the amount of equity they have. And the lower the ratio, the better the financial position is. So you don't want that ratio to be really high, because that means the company has a lot of debt relative to the equity of that business. Working capital is your current assets minus your current liabilities. And the higher this amount is, the better your financial position is for your company. Because what that means is you have a lot more current assets, essentially assets that are convertible to cash or in cash within a 1-year period, versus the amount of liabilities that you have that are due within a 1-year period. So again, the higher the amount, the better your financial position is. That is, the working capital is current assets minus current liabilities. Current ratio is your current liabilities divided by your current assets divided by your current liabilities. So it's essentially the same thing, except we're taking a ratio of it. Same principle applies. The higher the current ratio, the more viable a business is, the stronger they are financially. Profit margin. So the profit margin is essentially your net income divided by your total revenues. There are different profit margin ratios. You can do gross profit margin, net profit margin, but for this particular scenario, we're only looking at the net profit margin, which would be 240 divided by the $1 million of revenue. The higher your profit margin, the better your financial position is going to be for your business. So when you're trying to look at key pertinent ratios, you want to look to see how you can expand your profit margin, how you can have more profits with the least amount of expenses associated with generating that revenue. Okay, now let's go to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Now, why is that important? I mentioned earlier that depreciation is a non-cash expense. So when a bank is looking at your cash flow, they're not looking at just that $240,000 of income that you're showing on your income statement. They recognize that that $35,000 is a non-cash expense. So they're going to add that back. In addition, they're going to add back interest that you're paying on any debts, because most likely they're going to pay off that debt and issue you new debt. So they want to know what your total income is before your interest, your taxes, and your depreciation. We didn't include taxes in here, but if there were taxes in there, we add those back in as well. Now, the other ratio, the debt service coverage ratio, is a real key point that banks look at when they're trying to determine whether or not you're a good candidate for lending. The higher the debt service coverage ratio, the better. Typically, you want at least 1.25 or higher. And the way that debt service coverage ratio is calculated is you take your total debt payments that are due as your numerator, and then your denominator is going to be your cash flow. The other way around. The top, your numerator is going to be how much cash flow you have, and then your denominator is going to be how much debt service that you have to pay for it. So your monthly payments. And the higher that ratio is, the better, because that shows that for the amount of debt that you have, your payments, you have sufficient cash flow to pay for that those monthly payments. So very important ratio to keep into consideration. I know it's a lot of information I just threw at you, and these are some very, very brief ratios that we looked at and some brief financial statements, but this should give you a good flavor of what things banks look at when they're determining whether to lend money, how you as a business owner should look at your financial statements, and what are some key things to take into consideration when you're taking on new debt. But it's very important to work with a good CPA and a good banker to help you formulate the best strategies for you for growth. Okay, now I'm going to turn it back over to Tom.
All right. Thank you very much. I couldn't agree more with you. When I talk with clients, I tell them they need 3 key people on their team in order to grow and be prosperous. And that is, a good banker, a good attorney, and a good CPA. But what does it take to be a good CPA, a good banker, a good attorney? Well, for a banker, the more years they have under their belt, the more experience they have. And you should always ask your banker, tell me a little bit about your background, so you get an understanding on the banker's background. Is it retail based or is it commercial based? So ask a few questions, but it's important to meet with your banker to go over these numbers. And don't be afraid to ask the banker about the numbers. Hey, what direction are my receivables going in? What direction is my payables going in? What direction is my business going in? How can I better profit it? We're not business advisors, but we know a lot about businesses and how they operate and how to make them very effective. So I can't speak about attorneys, but when it comes now down to your CPA, I guess I'd have to ask you now, why would you want to hire a CPA?
Well, a CPA will help you develop strategies on how you can grow your business. So it could work with you and look at your financial statements, especially if you're planning on potentially buying a building or expanding or buying equipment. It's a good idea to start planning ahead of time, so that way you can make sure your financial statements are well prepared, that they're accurate, that they're structured in a way so that way when you go to a bank and ask for financing, that all your ducks are in a row. Another great reason to hire a CPA is for monitoring profitability and then helping determine valuation. So monitoring profitability is talking about all the ratios and the financial statements I talked about earlier, and how you can make sure that you're improving those ratios. So when you're going to talk to a bank, you put your best foot forward. Calculating depreciation. We talked about depreciation earlier. It's important to know how you can accurately calculate depreciation, because there are many different forms of depreciation. There's depreciation, there's amortization, there's depletion. So you have to recognize which form of depreciation is applicable and how to calculate it. And then obviously to prepare your tax returns and do other ancillary activities such as payroll, bookkeeping, those types of things. So if you have any questions, please put them in a chat box. We will get to all the questions towards the end. Any comments before I get to the questions, Tom?
No, I think I'm good at that. Let's see. Do we have any questions coming in so far?
Oh yeah, we've got quite a few questions. So let me get to the first one. Why does only the interest portion, not the full amount of the loan payment, get deducted against my income? That is a great question. So if we were looking at the income statement, we'll see that when you're making a payment, not all of that is going towards interest. A portion of that's going towards paying down the loan. So when it goes paying down the loan, you have to recognize that that is a deduction from the loan on the balance sheet. But the interest portion is what's actually being reported on your income statement. So you cannot deduct the entire amount against your income, because not all of it's going towards paying towards interest. It's only the interest portion, and then the principal part is going towards paying down the loan.
And Ara, on an equipment loan, I can see that and get that understanding. Is that where depreciation comes into play?
Yes, absolutely. So for an equipment loan, depending on the life expectancy of the equipment, You can do different types of depreciation. You can do accelerated depreciation where you depreciate it over a 1-year period. You can do it where you depreciate it over its entire useful life. And then when that happens, that expense, which is again a non-cash expense, also gets deducted from your income statement. But at the same time, that same amount gets deducted from your balance sheet against the value of that equipment. Okay, so let's go on to other questions we have. I'm an S corporation and never leave much equity in the corporation, but it appears that it would negatively affect my ratios to qualify for a loan. That is a really good question as well, because Tom, I'm going to pass this on to you because, as a banker looking at financial statements, obviously many companies are S corporations, and there's no viable reason to leave that much equity on the financial statements. But if they're a profitable company, you're able to read between those lines, right?
Oh, definitely, definitely. And that question is very well put. Most S corps don't leave equity in the corporation, and so what we look on a global aspect of this. We don't look at just the corporation. We look at the individual that's behind the S corporation, and how much money are they taking out of the corporation, and where are they putting that money. So even though you don't see the equity in the corporation, because it could be just a shell company in that respect, or just a shell company, where does that money go to? And so we follow the money. And you find out on individuals, where are they putting their money? Are they putting it in the stock market? Do they have it in real estate? Do they have in other investments? And what are those other investments? Do they own other practices? There's a totally different way you can take that money and go somewhere with it. But that's what we do. We look at it on a whole big picture aspect. So you do get the credit there.
That's an excellent point, Tom. I think what's important for viewers or listeners to know is, as a banker, you look at this every single day. I mean, you see hundreds and thousands of financial statements. So you recognize how to evaluate these financial statements to see where that money is going. And we all recognize that people are trying to minimize their taxes as much as possible and not to try to keep what I call dead equity on the balance sheet. So it makes total sense for an owner to draw that equity out and use it for other purposes, as long as we can track it. I'm gonna ask this question to you as well, Tom, because I think this is a great question that you can answer. How can I make my financial statements look better to qualify for a loan? So what are some things that people can do ahead of time before they're about to apply for a loan?
Well, the best thing to do is just to talk to a banker, first of all. My number's at the end as well. Happy to give me a call, but there's nothing you can, you got to be honest when you're talking to your CPA who's preparing the financial statements. But again, sometimes we have businesses that do company prepared financial statements, and hopefully they're prepared according to GAAP. And that's what we like to see. But occasionally we see financial statements that are not prepared according to GAAP, and it's hard to figure out where the assets are, where the liabilities are, where's the goodwill, it's hard to, and it's not in a format we're used to seeing from the CPAs. Makes it difficult to read. So always do a financial statement according to GAAP. But the best way is just to be honest. If you don't have a lot of assets, then don't show a lot of assets. But if you want to make a financial statement look better, your business is what it is, and it's got the assets it has. If it doesn't have the assets and you want assets to build the financial statement, then that's something to talk to your banker about. What ratios am I looking at right now? Where are my ratios not making sense? That's what you'd want to ask a CPA or a banker, and have them tell you, well, look, according to the industry, and we have industry standards we look at, businesses of your type, of your income level, have this much in assets or this much in debt. Debt can be a good thing. Debt can help take your business to the next level. So there are businesses out there that are very cash rich, and they're like, oh, I don't believe in debt. Well, as long as you're making the cash to grow the business, then don't take on the debt. But a lot of businesses, when they want to grow, they want to go to that next level, then they need to take on a little debt to make that growth. So again, the best financial statements we like to see are CPA prepared, because there's a quality standard there that we really like to see, and it makes a banker feel better having it prepared by the CPA versus the company. Not that companies are not good, but you saw Enron's books. They weren't that great. And anyways, I hope that answers that question for you.
Oh, yeah, that was a great answer, and I couldn't agree with you more. And I was kind of chuckling because I remember seeing a financial statement a while back from a company that had an accounts receivable from the IRS, and I said, "I'm pretty sure that you don't have an accounts receivable from the IRS." So it was the financial statements are completely in disarray. So you want to make sure that you have proper financial statements, and even if it's not for bank financing, you want to know for your own benefit. If you don't have proper financial statements, how do you know if taking on a new project or taking on a new patient or a new client is financially profitable for you? You need to understand those numbers and those ratios to make better investment decisions on your own as a business owner. So you really need good financial statements and good reporting to be able to know the health of your business. Okay, so let's go to the next question. I'll take the next question, Tom. It's about bonus depreciation. What is bonus depreciation? So I mentioned what depreciation is. So let's assume you buy a building well, I'm not going to use a building because there's a land associated with it. Let's say you buy equipment and the equipment has a 10-year lifespan. Well, during that 10-year period, if you do a basic, what's called a straight line depreciation, you would divide how much you paid for that equipment by 10 years, and then that amount would be how much you would depreciate over that 10-year period. So at the end of the 10 years, you basically have zero left on your balance sheet because you've over time deducted a portion of depreciation over time for that 10-year period. When you do a bonus depreciation, you take that entire 10 years and you crunch it up into 1 year. So you can depreciate the entire equipment all in 1 year. Now, someone would ask, why would you do that? Well, one of the benefits is that let's assume that you have a year where you have a great year. It's a banner year. You bought some equipment and you want to reduce your tax liability. Well, you would take that bonus depreciation and it will reduce your taxable income so that way you pay less tax. But you have to recognize that once you've taken that bonus depreciation, then that asset is fully depreciated. You can't take any more depreciation. So you have to make a business decision working with your CPA. Does it make sense for me to take a bonus depreciation now and forego that depreciation later on if I think my revenues are going to decline, or if I'm going to be continuing to buy equipment every year and take that bonus depreciation? Okay. Anything else you want to add to that, Tom, that I just described?
No, that was great.
Okay.
I fully agree with you. I think that was a great definition of what bonus depreciation is. So good job.
There's a question here related to lines of credit. Are all lines of credit secured? Because you mentioned, well, there's actually, it looks like it's two-part. Are all lines of credit secured, and are they all interest only, and what are the rates? I don't know if you understood that question, but.
Okay. I do. Yeah, there are different types of lines of credit. There are secured lines of credit, and there are unsecured lines of credit. If you can get an unsecured line of credit, it's based upon how strong is the business. If it's a weak business, then the bank's going to ask for some collateral. If there's some weakness in the ratios, for example, or the direction that the company's going, then the bank may ask for collateral, and therefore the line of credit jumps from unsecured to secured, for example. And on the rates, what are the rates? Well, the rates, they're always an adjustable rate. Very rarely will you ever see a line of credit with a fixed interest rate. They're always adjustable. They're either tied to Wall Street Journal Prime or LIBOR. And there's what's called a spread that's put on top of that index. And that spread is going to be based on how risky is the business. If it's a low risk situation, you'll have a lower interest rate, prime plus 0, prime plus 1, prime plus 2. If it's a risky situation, if there's a lot of risk involved, IRS receivables, for example, that's risky. Then you're going to have interest rates of prime plus 3, prime plus 4. It's all risk-based. You look at your credit cards, they're 27, 25, 22% interest rate because they're unsecured and there's a lot of risk involved. When you get into lines of credit, they're secured by a business's inventory, for example, or equipment, or receivables, or even commercial real estate can secure a line of credit. It takes the risk off the table and allows the bank to reduce the interest rate on that.
That's a great answer, Tom. Thank you for for elaborating on that. We are at the end of our webinar. If you do have some questions, like I said, we are going to be posting this on all of our social media sites. So it'll be an opportunity for you to also ask questions, but you can also reach out to either one of us. Tom's information is on the current slide right now. My information is on there as well. If you have any questions related to banking, loans, credit facilities, please reach out to Tom. He's a great resource for that. If you have any questions related to taxation and financial statements, please reach out to me. And we really appreciate you being part of this webinar. We're hoping to have more of these webinars, informative to educate everyone. And thank you again for participating.
Thank you, all right. Great job.
Thank you. Bye-bye.